Fellow viewers, my name is Richard Land. I'm a Connecticut-based attorney and a member of the Danbury, Westport, and Southbury, Connecticut law firm Chipman, Mizuko, Emerson. As an attorney, I devote all my time and energy to estate planning, estate settlement, and trust administration. Here's another important reason to review. There are a lot of wills out there that include a formula that says when one spouse passes away with the other spouse surviving, an amount equal to the federal exemption is carved out of the estate of the deceased spouse and goes to a trust for the surviving spouse. That's what this diagram is meant to represent. There is, in this case, a $6 million estate. The federal exemption in 2008 was $2 million, so this is the result they expected under the 2008 rules. The $2 million federal exemption would be carved out of the estate, and an amount equal to the exemption would go to a trust for the surviving spouse. The surviving spouse would get the rest. That's the result that was expected back then when a formula was used based on the 2008 federal exemption. But the federal exemption has been increasing, so as the federal exemption increased to $12,060,000, which is what we have right now, the portion passing to the surviving spouse has been eliminated. Keep in mind that the federal exemption is scheduled to return to a lower amount in 2026. Now let's assume that the federal exemption at that time is $6 million, and let's also assume that the Connecticut exemption in 2026 will be $2 million, the 2008 level. These are plausible possibilities and designed to make a point. Under these assumptions, this could be the result if death were to occur in 2026. What changed is the federal exemption. The formula in the will says, put the federal exemption in the trust, everything else to my spouse, but nothing else is left. It all went to the trust. So the surviving spouse may feel like she's been disinherited. Not only will the surviving spouse be disinherited in this case, but the amount that goes to this trust is more than the Connecticut exemption of $2 million, and therefore there's a Connecticut tax to pay on it. That's not a good result. The point is that people who have these old formula wills based on the federal estate tax exemption need to have them reviewed, because if they don't, the final result may be a very unhappy surviving spouse and may be unnecessary taxes. There are other types of provisions that make use of a similar formula that may relate to charitable dispositions and generation skipping tax dispositions. So it's not always the marital husband and wife situation. Sometimes a single person uses a similar provision that is related to the federal exemption. Now I'd like to go back to incapacity planning. When planning related to your possible incapacity, you should give your powers of attorney and healthcare instructions a fresh look. For this presentation, however, I want to focus on revocable living trusts as a very important tool for protecting assets and protecting you while you're incapacitated. Over the years, my views on this topic have changed quite a bit. They've changed as the probate court system has been reformed and changed as my clients have aged. And they've changed with the number of clients we get in that have been the victims of financial elder abuse. Making a revocable living trust a part of your estate plan is a way to make sure that there are some responsible people looking in on your financial situation at a time when the frailties that come with age make you more vulnerable. A revocable trust can be a very good way of setting things up so that other people, maybe trusted family members or your accountant, lawyer, or best friend, can look in on the situation and make sure somebody knows what's going on when there's an effort being made by an unscrupulous caregiver or an unscrupulous child to basically get his hands in your pocket and take what you have for himself. Powers of attorney are too often abused because it's so easy to use them in a way that's not noticed until it's too late. So now, I'd like to take some time to explain how a revocable trust works. The thick black line on this chart symbolizes death. Before you pass away, above the black line, Wills have no effect at all. The will is only effective at death. A revocable trust is established through a trust agreement. That's something you do now, while you're alive. And because it's established now, it's effective before you pass away. And it can have provisions in it that deal with lifetime issues, like your incapacity. For example, let's say I'm the one who wants to create the trust. I'm called the grantor of the trust. And as the grantor, I go to my attorney and I have him write up an agreement. And the agreement says that I'm the main beneficiary of the trust. I can revoke the trust anytime I want. I can amend it anytime I want. And I appoint the trustees of the trust. Usually, I'm a trustee. I can be the sole trustee if I want to, but I personally believe it's a good idea to have a co-trustee. As long as I'm a trustee and I'm doing okay, I can make all the decisions for the trust. While I'm alive and well, the other co-trustee doesn't have to get involved, but there are provisions in the trust agreement that say, on my incapacity, the other co-trustee can take over. I can set up the trust so that, from the start, there are two trustees, and I can set it up so that some outside institution or person can get information regarding the trust. For example, I can tell my banker or broker to send copies of the account statements to my accountant or my lawyer or anyone else I trust, so that some good people are looking in to make certain that everything is on the up and up. That's a way to make certain that predators who would like to isolate me from others and take advantage of me while I'm vulnerable are unable to do so. And then, at death, the terms of the trust agreement can dispose of the trust assets just like my will can dispose of them. Any type of instruction you can put in your will, you can also put in your revocable trust. As mentioned above, the first step is to prepare the trust agreement. The next step is to retitle your assets so the assets are owned by the trust. The terms of the trust control only the trust property. So when you've finished the agreement and you've named a trustee, you need to retitle your assets so that your assets are owned by the trust. Only when you have done that, that is when the trustee has control over the assets. And if you retitle all your assets, except retirement plan accounts, you normally would not want to retitle retirement accounts. If you retitle all of your assets so the trust owns them, you avoid probate as well. The probate courts seem to be a little slower than they used to be. Back in the day, routine things could be done very quickly. With reform, it appears that it takes longer to get routine things done. So I like the revocable trust partly because I don't have to worry about so much delay. The trustee of the revocable trust is going to have almost immediate access to the assets in the trust when you pass away, instead of enduring the delays of a probate proceeding, which could take maybe 6 weeks. How much delay is involved depends on the court. One court can be much faster than another. Whatever the delay is, the delay can be a problem. When the financial markets are volatile and there is a lot of uncertainty, that period of time when no one has authority to make decisions to protect the assets can be very uncomfortable. Let's talk about how probate courts handle trusts that are created by the terms of your will, what we call testamentary trusts. Before we talked about how trusts can be used to solve certain problems related to taxes and management of assets for beneficiaries who are young or who need other types of asset protection. If you set up a trust through the terms of your will, a testamentary trust, the testamentary trust continues to be subject to the jurisdiction of the probate court, and it's a requirement at the end of the line when the trust terminates that the trustee file an accounting in the court. Once upon a time, not too long ago, the maximum probate court fee for that type of account was $750. But things have changed, and so, just for a 10-year account, with the fact pattern shown in this slide, the fee might be close to $4,000. So the administration of a trust in the probate court is a bit more expensive than it used to be, and you may want to consider a plan that avoids probate court jurisdiction. If you establish a trust that continues for the benefit of your beneficiaries after you pass away through a revocable trust, a trust that's established by an agreement while you're alive and not subject to probate court jurisdiction, then you can avoid that fee. The trustee, if need be, can always ask the court for assistance because the court has jurisdiction if the trustee asks for assistance. But there are many situations when the termination of the trust can occur in a businesslike manner without probate court involvement. So that's one thing to keep in mind. We were just talking about probate court fees related to trust administration. The fees of the probate court for estate settlement are different. The probate court fees for settling an estate, those upfront fees that relate to what happens shortly after you pass away, are the same whether you avoid probate or not. And here are the relatively new probate court fees for estate settlement. The cap on the fee was increased in January 2015 from $12,500 to an amount which in 2017 became the current maximum of $40,000. We've discussed many of the changes and circumstances that you might go through that should trigger thoughts about reviewing your estate plan. I want to spend some time on something you should be thinking about if you want to move out of Connecticut to another state for tax reasons. When you want to change your home for tax purposes, that is, you want to change your tax home, or what we call your domicile, to do it properly, you pretty much have to give up all your connections here in Connecticut. You give up your church membership, you give up your car registration, you get it registered in the other state, you change your voting registration to the other state, you file your individual income tax returns in the other state, you give up your club memberships, and you join clubs in your new state. You shouldn't keep the connections that you have here in Connecticut. Also, don't travel to Connecticut too much. So you need to make it very clear to Connecticut's Department of Revenue Services that you are giving up your domicile and you do not intend to return to make it your home in the future. You have to do all these things that I just mentioned. And in addition, even if you've done all those things, you need to give up the real estate you have in Connecticut. If you have real estate here, that's an opportunity for the Connecticut Department of Revenue Services, or the DRS, to claim that you never really left and, therefore, you remain subject to Connecticut estate and income taxes. The DRS can be very hard on your beneficiaries after you pass away because your beneficiaries will not be able to sell that real estate in the future unless they get a release of estate tax lien, and they will not be able to get the release of estate tax lien without going to the probate court and filing an estate tax return with the DRS. Also, if when you pass away you own that real estate solely in your own name, it's probate property, and your beneficiaries will need to go through the probate court in order to prove that they have good title to the property. So, through the probate process, the DRS will know the real estate is there. So, what do you do when you move to Florida or Texas or wherever you end up going? You can sell the real estate, that's one way to handle it, or you can make sure somebody else owns it. In other words, you can give it to your children. Keep in mind, though, for estate tax purposes, when you're making sure somebody else owns it, making your revocable trust the owner won't be good enough. On the other hand, establishing a properly structured limited liability company, an LLC, to own your Connecticut real estate seems to be the best way. But Connecticut's DRS is aware that people are doing this type of thing, and DRS and the legislature are always coming up with new legislation to make it difficult. So, if you want to avoid the problem, be prepared to give up most of or all the ownership and control of the LLC that you create for this purpose. There are a few more common changes that often occur in a normal human life cycle. Let me briefly mention them. Maybe some of you have remarried. If that's the case, it's time to review your estate plan. If you've done a prenuptial agreement, when you review your estate plan is a good time to make certain that your will takes care of any obligations you have under the prenuptial agreement. Birth of a child should also be something that triggers a review. If you're married to a non-citizen spouse who became a citizen, and if you have some provisions in your old will that dealt with the tax issues related to being a non-citizen spouse, You might want to consider whether such provisions are still appropriate, and you may want to review whether it creates an opportunity to reallocate assets between the spouses in a way that will achieve a better tax result. That's the end of this presentation. I hope you've learned something from this video series, and if you have any questions, we would like to be there for you and help you answer them. But for now, thank you and goodbye.